The electric vehicle startup industry faces significant setbacks in the stock market as investors have lost faith in several companies that went public recently, including Lucid Motors, Rivian, Nikola, Hyliion, Hyzon, Mullen, and Proterra. Although these companies may perform relatively well given the current economic climate, their stock prices tell a different story. This can be attributed to the hype generated around electric vehicle companies following the success of Tesla, which led to a rush of people investing in other such companies. The consequences of this hype are now being felt. This video will delve into the consequences of the hype surrounding electric vehicle startups and why they are struggling in the current economic environment. Before we begin, give this video a thumbs up and subscribe to our channel, Voltify, if you haven't already. Electric vehicles are playing a crucial part in the race toward decarbonization. However, recent developments over the past 6 months have significantly shaken the confidence in the ability of certain companies to generate profits. While this outcome might be expected in the challenging auto industry, rising competition from traditional original equipment manufacturers and economic instability in China, along with higher interest rates and a slowdown in economic growth in the US, is causing apprehension regarding electric vehicle companies. The effects of these advancements go beyond only delivery and encompass production expenses and investment opportunities. According to quarterly reports, several U.S. electric vehicle startups are facing a troubling pattern as potential customers wait for bargains or delay their purchases, leading to a weakened interest in many of their newer products. This trend is particularly concerning for companies dealing with high costs. Lucid, Rivian, and Nikola have all reported economic pressure, and industry experts suggest that Tesla's price cuts and the availability of cheaper EV models from traditional automakers have diminished demand for these startups' new vehicles. However, Fisker, which has just begun production of a $37,499 SUV, has seen an improvement in orders due to its low price point, one of the cheapest in the EV category. Meanwhile, Tesla's Model Y starts at $54,990 after recent price cuts. Rivian's R1S SUV is priced at around $78,000, and Lucid's Air Pure sedans cost approximately $87,400. Rivian's stocks experienced a decrease of approximately 13%, whereas Lucid, Nikola, and Fisker's shares saw a decline ranging from 2% to 4%. On the other hand, Tesla exhibited a 1.3% drop in trading. Recently, Rivian and Lucid Motors, two prominent players in the electric vehicle market, released new data that has significantly affected Wall Street's pricing expectations. For example, Lucid Motors had estimated in their investor deck before their IPO in 2021 that they would be delivering around 49,000 vehicles in 2023, based on their expectations for the economy in 2021. However, with only 1,400 deliveries in the first quarter of 2023, it seems unlikely that they will meet their production and delivery targets. Additionally, Piper Sandler, one of Rivian's most bullish analysts, recently lowered their price target for Rivian's stock by 75%, from $63 to $15. However, the significance of this Rivian news goes beyond the mere price target downgrade. What is more crucial is what this downgrade reveals about the prevailing sentiment in the stock market. The analyst's statement in the Target Review succinctly encapsulates the current market mood. In this market, frugality matters more than ambition. This quote perfectly captures the essence of the 2022 bear market. When the economic outlook turns negative and interest rates rise to levels unseen since the last global financial crisis, investors undergo a significant shift in their risk appetite. Even the most innovative companies in the market today may not be able to attract investment if they do not align with this newfound preference for frugality. Unfortunately, this shift in sentiment is evident in the performances of many publicly listed EV stocks, which have declined by anywhere from 56% to 74%. Will these companies burst, or will they take the world by storm? Find out by subscribing to Voltify now. The significant decline in the value of highly ambitious companies in the technology and engineering sector is apparent. As Warren Buffett wisely stated, it is crucial to be cautious when others are greedy, as we witnessed in 2020. During this time, greed was the driving force in the stock market and venture capitalist world. People were becoming wealthier and wages were increasing. Innovation peaked due to the surge in productivity resulting from remote work, and overseas companies had a surplus of cash for growth and capital spending. Every company and executive in the electric vehicle industry appeared to be a genius during this period. The company's financial condition became irrelevant as venture capitalists and investors in the public market poured money into these businesses. This was the primary reason these companies could go public, raising funds from banks and significant institutional investors. What people realize is that the total addressable market for electric vehicles in the automotive industry is vast. The global automotive market is valued at over $800 billion, and if a company can capture 2 to 5% of that market share in the United States, it could generate revenue in the share of $5 to $10 billion. With a decent automotive PE ratio, these companies could be valued at $10 to $30 billion. Investors bid up prices, leading to the current bubble unfolding. Every EV stock that went public in recent years did so at its discretion, whether it was timing the intraday or interweek cycles of the stock market, fiscal or monetary bills, or the 2020 election, where President Biden's pro-EV and pro-clean energy investments would be prioritized. Each company in this space had its agenda to take the company public at the most optimal time. The current downturn in the market is temporary, however, it does not necessarily mean that every EV company listed on the public markets will survive, as there are no guarantees. Nonetheless, we are witnessing an opportunity in the market upheaval today. For instance, Tesla's market cap is $588 billion, whereas Lucid, Polestar, and Fisker are valued below $14 billion. This comparison is not to predict the future value of these companies, but to emphasize the stock market's appetite for successful EV businesses. Furthermore, the automotive industry is vast and multiple players will target specific customer niches, as evident from the success of Nissan, Toyota, and Honda in Japan, among others. However, the short-term reality is that when interest rates rise to 5%, people and investors tend to favor zero-risk bonds. Additionally, some people caught up in the enthusiasm around EVs might have thought of making a quick buck, leading to sudden liquidation of their positions, resulting in the current stock prices. The circumstances have become so severe that some companies, such as Nikola Motors and Rivian, are trading at a value lower than their book value per share on their balance sheet, which means they are being undervalued in relation to their actual assets when you deduct their liabilities from their cash position. In conclusion, the electric vehicle market has seen a surge of startups, with Lucid, Nikola, Rivian, and Fisker leading the charge. While these companies have generated excitement, concerns about their long-term viability exist. As the industry evolves, time will tell which companies will succeed and which will struggle to keep up. Regardless, the electric vehicle market is poised for significant growth, and it will be fascinating to see how these startups contribute to the industry's development. Do share your thoughts and viewpoints in the comments section below.